Imagine the last time you dropped $20 without even blinking. Perhaps it was on a quick meal, a latte, or something small you spotted online. Did it really change your day? Probably not. But what if that same $20, instead of disappearing into thin air, could grow into a steady stream of income, like $5,000 a month? Sounds like a stretch, right? Well, stick with me. In this video, I'll walk you through how to turn a modest weekly investment into a portfolio worth hundreds of thousands that pays you handsomely every month. I'll break down the process, show you how to pick the right investments, and reveal how $20 a week can transform into a life-changing nest egg. Welcome to Blue Chip Mindset, the winning mindset for success. If you enjoy the video or learn something new, please give it a like. First, let's get a grip on the basics. Fundamentally, this revolves around dividends. Money companies distribute to shareholders from their earnings. It's a reward for investing, typically paid quarterly every 3 months. If you own stock in a company that pays dividends, you get a slice of that payout based on how many shares you hold. For instance, picture a company offering $2 per share in dividends. If you've got 50 shares, that's $100 headed your way. You don't need to sell your shares to earn that cash. It's yours simply for holding the stock. Some companies, like those in stable industries, have been paying dividends for decades, turning a small stake into a reliable income stream over time. Dividends are a secret weapon for building income you don't have to work for. Say you put $2,000 into a stock with a 4% dividend yield. That's $80 a year flowing to your account with no extra effort required. Over time, your earnings can snowball if the company boosts its dividend or you reinvest that money. But here's the catch. Not every dividend is a sure thing. Some businesses have a rock-solid history of increasing payouts, while others might slash them when profits dip. The trick is to zero in on companies with a proven track record of reliability and growth. Think of it like choosing a tenant for a rental property. You want someone who pays rent consistently, not someone who might skip out when times get tough. So how do you make the most of these dividends? There are 2 paths, the non-drip method and the drip method. With the non-drip method, your dividends arrive as usable cash in your account. Invest $2,000 in a stock yielding 4% and you'll pocket $80 by year's end. Spend it on bills, a treat, or anything else is yours to decide. Assuming no changes, you'll get another $80 next year. Your initial $2,000 stays unchanged unless you invest more or the stock price rises, but the dividends themselves don't fuel additional growth. Now flip that to the reinvestment route, often called a dividend reinvestment plan or DRIP. Here, your dividends don't sit idle. They buy more shares automatically. Start with that same $2,000 at 4%, earning $80 after year 1. If the stock's still $50 per share, that $80 grabs you 1.6 more shares. Now 41.6 shares total, not just 40. Year 2, 4% yield on $2,080 nets $83.20. Reinvested, you're at 43.26 shares. Year 3, dividends hit $86.52, pushing you to 44.99 shares. Non-drip after 3 years. $240 cash, 40 shares, worth $2,240. Drip, 44.99 shares, worth $2,249.50, without lifting a finger. There's a small gap early on, but over decades, this compounding turns modest sums into fortunes. Picture planting a tree. The non-drip method gives you apples to eat now, but drip grows the tree taller, yielding more fruit each season. Now, how do you pick investments that make this work? It's not about throwing darts at a stock list. You need a strategy. First, look at dividend yield, how much a stock pays relative to its price. A high yield can mean bigger checks, but it might signal trouble, like the company struggling to keep up payments if it's too high. Aim for sustainability over flash. Next, check the company's staying power. Firms with steady profits and a history of weathering storms, like those in groceries or utilities, are less likely to cut dividends when markets wobble. Diversification matters too. Don't bet everything on one industry. Mix it up with stocks from tech, real estate, or healthcare to cushion against sector slumps. Finally, consider growth. A stock that pays today but also rises in value over time doubles your wins. Income now, wealth later. Researching these factors takes time, but it's like building a house. You don't skimp on the foundation if you want it to last. Let's build a sample portfolio with 5 stocks that fit this mold, each chosen for reliability and potential. But before we do, if you're enjoying the video so far, please tap that like button, as it helps get this video out to more people like you, and subscribe to the channel. I'd love to have you aboard. First up, extra space storage, ticker EXR. This is a real estate investment trust, or REIT, focused on self-storage. People rent units to store their belongings, rain or shine, giving EXR a steady cash flow. They stash furniture, keepsakes, or seasonal items like skis and decorations during moves, downsizing, or home upgrades. Small businesses also rely on them to store extra inventory, equipment, or records. This constant need, no matter the economy, fuels demand. It's yielding around 4.2% above the market average and has grown its dividend by 12% annually over the past decade. Plus, its share price has climbed 6% a year, blending income with growth. Next is the Vanguard Dividend Appreciation ETF, ticker VIG. This fund bundles U.S. companies with a habit of hiking dividends, spanning sectors like tech and consumer goods. It's a one-stop diversification shop yielding about 1.8%. Its dividend growth rate is solid at 9% annually, and its share price appreciates around 7% yearly. Lower yield, yes, but the stability and spread make it a cornerstone. By tracking firms with strong balance sheets, it reduces risk compared to single stock bets. Plus, its low expense ratio, typically under 0.1%, keeps more of your money working over time. Third, meet Costco, ticker COST. This retail titan sells everything from bulk cereal to TVs, thriving in good times and bad because people always need essentials. Its yield is modest at 0.8%, but its dividend growth is a whopping 13% annually. Add in a 15% yearly share price increase, and it's a powerhouse for long-term gains. Costco's secret? It's not just about dividends, it's a growth machine that keeps rewarding patient investors. Fourth, Johnson & Johnson, ticker J&J. This healthcare giant makes medicines and baby shampoo, a steady ship thanks to constant demand. It yields 2.9% with a 6% annual dividend growth rate. Its stock price grows about 5% yearly, not flashy, but dependable. J&J's has been a dividend aristocrat for over 60 years, a testament to its resilience. Its diverse product line, from Band-Aids to cancer drugs, cushions it against market swings. Decades of consistent payouts make it a favorite for income seekers who value reliability over hype. Lastly, Tencent, ticker TCEHY. This Chinese tech firm dominates gaming and social media, tapping into a booming global market. It yields 1.5%, but its dividend growth clocks in at 15% annually, and its share price has soared 14% yearly. It's a riskier pick, but the upside balances the portfolio. With hits like Honor of Kings and Stax and global gaming giants, its growth potential is massive. So how do you invest that $20 weekly? Split it evenly. $4 per week into extra space storage, Vanguard Dividend Appreciation ETF, Costco, Johnson & Johnson, and Tencent. That's $208 yearly per stock, building your portfolio step by step. Most modern platforms like Robinhood or Webull, link in the top comment pinned, let you buy fractional shares commission-free so you can invest every cent without waiting to afford whole shares. This steady $4 drip into each stocks sets the stage for the growth you'll see next. Small moves and significant results over time. Now let's crunch some numbers. Extra space storage, 4.2% yield, 12% dividend growth, 6% price growth. Vanguard Dividend Appreciation ETF, 1.8% yield, 9% dividend growth, 7% price growth. Costco, 0.8% yield, 13% dividend growth, 15% price growth. Johnson & Johnson, 2.9% yield, 6% dividend growth, 5% price growth. Tencent, 1.5% yield, 15% dividend growth, 14% price growth. Average combined comes to 2.24% yield, 11% dividend growth, 9.4% price growth. This portfolio is a triple threat: decent yield, strong dividend increases, and solid growth. What does $20 a week do here? Year 1. $1,040 invested with 9.4% return from price growth and 2.24% from reinvested dividends. Year 5. Roughly $6,500 with weekly contributions and compounding. Year 10. $18,900. Year 20. Nearing $75,000. Year 30. Portfolio hits $315,000. Then 2.24% yield on $315,000 is $7,056 yearly, or $588 monthly. With dividends growing 11% annually, after 30 years, annual dividends reach $60,000, $5,000 a month, all from $20 a week. That's the magic of starting small, choosing wisely, and letting time do the heavy lifting. Your total portfolio value after 30 years around $315,000, with roughly $157,500 from share price gains and $157,500 from reinvested dividends. But let's be real. Markets aren't a straight line. These numbers assume a steady 11.64% return and 11% dividend growth, which is optimistic. Recessions, company stumbles, or slower growth could trim that $5,000 a month to $3,000 or less. Past performance isn't a crystal ball, so plan with flexibility. Want to aim higher, say $15,000 a month. Tweak the strategy or increase your weekly input. The blueprint's here. It's not instant, but it's real. Start with what you can, monitor your picks, and adjust as life unfolds.